Of course, we are not just interested in shareholder value as an ideology, are interested in its role as a practical form of governance. And so, how was it actually implemented? How did shareholders actually take control of companies? Well, two of the foremost proponents of this system were Mike Milken and Ivan Boesky. In the late 70s and early 80s, when stakeholder theorists were adapting to incorporate solidarity into the system to overcome managerial hegemony, Freemanites aimed to crush this idea which they saw as a threat to freedom and instead to mobilise the power of shareholders. Ancient theories were arguing for a free market in corporate control, and Milken and Boesky brought this to fruition with the creation of the junk bond market to finance takeovers of underperforming corporations. They used the junk bond market, which grew as deregulation let more and more financial organisations get involved, just as investors were looking for higher returns in a market where low interest meant low returns on traditional investments. Who were they? Well, first, Michael Milken was a core belief. He championed high-yield bonds, nicknamed junk bonds, as a legitimate and transformative financial tool. He argued that these bonds, issued by companies with poor credit ratings, offered investors high returns to compensate for risk. He believed that non-investment grade debt could democratize access to capital for smaller or struggling firms, fueling innovation and economic growth. His daytime role was as a trader at Drexel Burnham Lambert, where he dominated the junk bond market, enabling leveraged buyouts and corporate takeovers. His work reshaped corporate finance but later drew scrutiny for enabling risky debt loads and unethical practices. Ivan Boesky was a financier. Born in Detroit, Michigan, he was the son of a Russian immigrant. He studied law and worked as a tax accountant before moving into securities analysis, forming his own firm in 1975. His core belief was he epitomized the greed is good ethos, focused on risk arbitrage, i.e. profiting from merger acquisition rumours. When he felt that shares were about to be bid on by a purchaser, he knew they'd go up in value, therefore he would buy and he would hold, or he would wait for the bid to come in and the share price would go in and he would cash in on that. He believed in exploiting market inefficiencies and insider information to maximise profits, famously stating, greed is healthy. Saw the stock market as a game where aggressive tactics and privileged information were key to success. Role as a prominent arbiter who amassed wealth by betting on takeover targets, often using insider tips. His illegal insider trading schemes, exposed in the 1986 Wall Street scandals, led to his downfall. Both Boesky and Milken were agency theorists, believing in it as an ideology, but also, like Adam Smith, believed that the public good would emerge from collective self-interest. The model they argued for in government was a free market in corporate control, i.e., public listed companies could be bought and sold on the stock market. If a company was run for some other purpose than to maximise profits, it would be undervalued. The value of its total issued share capital would be lower than the value of the underlying assets or underlying profit potential of the company, and therefore the shares should be bought up by people who will run it to maximise profit, releasing value, known as unlocking, to shareholders, enabling allocative efficiency that would see resources used across society in a more efficient manner. So, what was the junk bond takeover process? It started with target identification. A company that was identified as underperforming under its present management, either due to underutilization of assets, for example, allowing value extraction at excessive levels by executives, workers, or suppliers, or that was holding too much cash, failing to return it to investors, will be targeted for acquisition by a corporate raider, private equity firm, or management team. They started with the creation of a shell entity. The acquirer often creates a shell corporation, often with minimal equity, in order to orchestrate the takeover. This actually creates a situation in which there is a firm or an organisation which has very little history and therefore is not going to be raised money classically, but it just exists purely for the purpose of issuing junk bonds. So it then obtains, this entity then obtains junk bond financing. For instance, Milliken's Drexel Burnham Lambert would underwrite and sell high yield bonds rated below investment grade to institutional investors, e.g., pension funds, savings and loans, etc., and sometimes to private individuals. These bonds offered high interest rates, 12 to 18% to compensate for risk, attracting yield-hungry investors. They used a form known as debt stacking. The Shell Corporation used the bond proceeds to buy the target company's shares, financing up to 90 to 90% of the acquisition price with debt, the rest with the small amount of equity that was raised when setting up the Shell Corporation. The target company's assets or cash flows were pledged as collateral for the debt. Therefore, once having taken over, there would need to be a post-takeover restructuring. The acquired company's operations are streamlined. This could be layoffs, it could be asset sales, and this was used to generate cash flow to service the junk bond debt. Effectively, the buyout is financed by pledging the assets of the firm being taken over, with refinancing having to take place as quickly as possible to stop paying the high rates in the junk bonds, resulting in hurried asset sales and job cuts. Often it would have the appearance of a fire sale, but on an actual fully functioning company. Although this is often perceived as a historic problem back from the 80s, there is still a number of examples of this being engaged in, including the Glazers' purchase of Manchester United. So why did junk bonds work for takeovers? Simple. One was leverage. Minimal equity was required up front, 5% perhaps. The money raised with the sale of junk bonds provided most of the capital needed to purchase the company's shares. So if you could put up 5% of the money and persuade other people to lend you the 95%, you could buy very big companies from using very small companies. It was fast. Junk bonds could be issued much faster than traditional bank loans for as long as there were willing buyers, and it was scale. Milliken built up a considerable network of investors and institutional managers who trusted his judgment. Could this be an example of hegemony, for instance? He had built up a reputation as somebody who knew what was going on and was making profitable deals, and so people were prepared to take a chance on that, which resulted therefore in high market demand. Investors chased high returns in a low interest rate environment. With the expansion of financial markets, the rate of return on individual financial asset was falling considerably. This may remind you of something that we've seen in The Big Short. Investors were desperate for higher rates somewhere and therefore willing to look at an expansion of new asset financialization types. So how do you implement the policy once you've taken over a company? Well, the traditional method of running a company would be known as retain and reinvest. Retain and reinvest was a traditional long-term growth strategy where businesses prioritized investing profits back into a company rather than distributing dividends to shareholders. Key elements included profit retention, where earnings were retained, accumulated, instead of being paid out, preserving capital for internal use. It involved reinvestment. Funds were channeled into growth initiatives like R&D, market expansion or acquisitions, infrastructure or innovation, possibly funding training, etc. for staff, etc. This is the benefits of compound growth. Einstein described it as one of the miracles of the universe, where if you reinvested early, over a number of years, it would accelerate expansion, allowing market dominance and competitive advantage. It gave the companies a higher valuation because there was potential for increased equity value as the business scales up, and allowed innovation, enabling continuous improvements and adaptation to market trends. This process had a number of challenges, however. The risk of failed investments meant that returns on investment were uncertain and may not materialise, so companies may not receive, they may wait for long, be willing to wait long term, but may not receive the benefits of waiting. Shareholder pressure. Investors seeking dividends often would become impatient, and the stock might fall in value as they moved out of it, which of course opened them up to takeover possibilities. And it became a dependence on long-term profitability. It required constant earnings to sustain the reinvestment cycles. But this model was seen as being too slow to hold hard, did appeal to shareholders. So it was decided that a new model was needed. And so they changed this model to something that became known as downsize and distribute. This economic strategy prioritizes short-term shareholder returns through aggressive cost-cutting, asset sales and debt financing, i.e. the use of high-risk junk bonds and leveraged buyouts. Key elements of it include downsizing, slashing costs via layoffs, operational cuts, or selling underperforming assets to boost cash flow, or simply outsourcing. And once it drains money, then this distributed profits would redirect freed up capital to shareholders via dividends, stock buybacks, and debt repayment. Has a short-term focus as it prioritises immediate returns over long-term growth. Benefits: rapid returns to investors or shareholders. Could revitalise stagnant companies through restructuring. And it exploited market inefficiencies for profit and improved allocative efficiency of resources. But there are a number of risks and criticisms involved in this. The junk bonds' high interest increased default risk, so there was a high debt burden on the firms. Overfocus and cuts may harm innovation, employee morale and operational capacity, plus lower training opportunities, and so there was an erosion of long-term value in the firm. And there were a number of ethical concerns as layouts and asset stripping seen as prioritizing profits over stakeholders such as employees, such as the local communities, etc. And success hindered very much on favourable economic conditions continuing to serve debt. So they were very much dependent on the market. And if the market started to fail in the bonds area, then companies could get into trouble, and we did see this start to happen. There was a number of criticisms, however, of maximising shareholder government, and Lazonick and O'Sullivan argued that the ideology of maximising shareholder value represents a radical shift in corporate governance. It prioritises short-term financial returns for shareholders over long-term value creation, undermining innovation, equitable growth and sustainable businesses. Their core arguments was that it was cuts, not investment. The high coupon on the junk bonds meant that cutting costs, layoffs, reduced R&D, riding pension schemes was needed to boost stock prices and distribute profits via dividends and or share buybacks, and they were paying a very high rate of interest meant that this could not be afforded very long term, so they had to effectively refinance the debt based on the companies they'd taken over, and those firms that may have been debt free after long term suddenly found themselves taking on large amounts of debt. In the long run, this undermined the sustainability of firms. It was a financialization of the economy. MSV incentives executives to prioritize stock price manipulation via buybacks, mergers, or accounting tactics over productive investment. Executive pay tied to stock options align managers with short-term shareholder interests, not long-term corporate health. There's a critique of agency theory. Maximizing shareholder value is rooted in agency theory, which frames shareholders as principals and managers as agents. Lazonick and O'Sullivan reject this, arguing shareholders are not residual claimants but transient investors. The model ignores other stakeholders, employees, communities essential to value creation. Example. It eroded innovation. Short-termism stifles R&D and human capital investment, weakening competitiveness, i.e. downsizing tech and manufacturing sectors, cripple the US economy in competing with China. Contrast with earlier areas where retained earnings funded innovation. We see that in IBM and Intel. What are the implications of this then? Well, Lazonick and O'Sullivan saw this as a growth of income inequality. Wealth concentrates at the top as profits flow to shareholders, executives, not workers. Corporate fragility as firms became vulnerable to market volatility due to underinvestment in core capabilities. And systematic risk, focus on financial engineering over production contributes to economic instability, as we saw in the 2008 crisis illustrated in The Big Short. So what did the market for corporate control lead to? Well, first we have Ivan Boesky we talked about. He was credited with, or blamed for, creating the junk bond market. Later, a symbol of the excess of the 1980s, He had become one of Wall Street's most successful arbiters when he admitted to insider trading charges in 1986, fined $100 million. He served time in prison before being given parole for good behaviour in 1990. Mike Milken, his crime turned the market for junk bonds into a gold mine for himself and Drexel Burnham. In a plea bargain, he agreed to pay $650 million in fines and plead nolo contendere to a few counts of stock parking and stock manipulation. Now he's still on the Forbes list of the world's richest in 2007, and he continues to devote much of his time and money to charitable efforts, including seeking a cure for cancer after he was diagnosed with prostate cancer. They committed crimes and they did time for them. However, the way they fraudulently obtained the information to identify underpriced stocks in companies where there was potential released value to shareholders, and how they identified either this for the takeover themselves to fund it or to gain money by obtaining the stocks and then greenmailing the prospective takeover people to have to pay more to get them off it, was why they went to jail. The illegal obtaining of information and manipulating stock prices by share parking, etc. They did not go to jail for asset stripping. This is not illegal. Regardless of the damage it was believed to cause, and regardless of the fact that people moved against them in believing that their approach was the correct one to help Wall Street, instead was seen to be prioritising Wall Street over the needs of ordinary Americans, that is not why they went to jail, though many would have liked them to, because that was not a criminal act. So the big question then we have to ask about this then is really, are shareholders residual risk bearers, as the founding claim of shareholder value makes out? Shareholders hold a claim on company assets and earning after all other obligations are paid, and this makes them the residual claimants. And this leads to the risk-reward trade-off. Since they are last in line during liquidation, they bear the greatest risk of loss if the firm fails in return, but they benefit from unlimited upside if the firm thrives. But as we know from Berle and Means talking about this, there are a number of other ways to look at shareholders, which include of them as speculative investors. Many shareholders prioritise short-term gains over long-term stewardship, acting more like renters than owners, and prioritise liquidity over loyalty, often exploiting market volatility rather than committing to a firm's resilience, transferring risks to others, employees, creditors, etc. during crises. Shareholders can also be seen as beneficiaries of limited liability. Shareholders' losses are capped. They may be the ones who get paid last, but they're capped at that level of investment. While other stakeholders, such as employees and communities, may bear uncapped social economic risks, job loss, environmental harm. Suppliers may get paid none of the money they're owed, and this may be enough to drive a supplier into bankruptcy, as was seen in some of the big corporate bankruptcies. They're extractors of value. Shareholders often prioritise short-term gains over long-term resilience, transferring risk to other shareholders. Underinvestment in work, in research and development, or in workplace safety for workers, etc., are classic errors and problems that have occurred because of this. They are risk displacers. Okay, creditors, for instance, bondholders, may bear significant risk in highly leveraged firms, even though shareholders technically hold residual claims. In addition, shareholders profit from corporate activities, i.e. pollution, low wages, while society bears the costs, which is known as externalization of cost. These are areas in which can be seen to play against the idea of the shareholder as a residual risk holder. They are also often seen as being power holders without accountability. Executives and boards often shield themselves from risk via golden parachutes, while workers face disproportionate consequences during downturns. And far from being only their value, they are just one stakeholder among many. Shareholders are not unique risk bearers, but one group alongside employees, customers, creditors, community who bear risk. For example, employees invest time and skills, creditors lend capital, communities provide infrastructure. All bear risk tied to corporate decisions. Prioritising shareholders alone ignores the interdependence of risks across stakeholders. Layoffs harm workers to boost short-term profits. For example, in the 2008 financial crisis that McKay made the films about, shareholders of banks like Lehman Brothers lost investments, but employees, homeowners, taxpayers bore far greater systematic risks. In short, while shareholders are legally residual risk bearers, real-world power structures and corporate practice often diffuse or displace risk onto other parties. This is the reality. We can argue both whether or not shareholders should have the benefits, while also looking at whether or not they can have the benefits, whether the system actually works, if we would, as we would like it to do. The issue is that to be effective as a form of governance, the theory of shareholder value governance requires too many other theories to be wrong. It requires the market for corporate control to be perfectly competitive. As we know, the reality of any market is far from perfect. In fact, too often we see those managers acting as agents, or the existence of hegemony and information asymmetry stops both existing shareholders replacing managers and outside shareholders stepping in as they do not have the knowledge of what is happening. This information asymmetry is what drove Milken and Boesky to act in the manner they did, using illegal means to acquire the knowledge they lacked. So was the law right, or did it just protect powerful executives who lie in their own pocket, not carrying out the will of their shareholders and their investors, and thus causing allocative inefficiency?